Welcome to Iron Financial, the only place you need to forge a stronger portfolio and really cut through all that market weakness. Today, we're not just glancing at an earnings report. No, we are conducting a full-on structural stress test on AeroVironment, ticker AVAV. And you know what? We have to. This company just dropped some numbers that are frankly baffling, and the market absolutely hammered it for them. So our mission today is to tear this report down to the studs, piece by piece, and figure out if this company's framework is fundamentally solid, or if we just saw the first deep cracks of a catastrophic failure.
Okay, let's just get right into the heart of the matter, because this is the headline that's got everybody just scratching their heads. You see a number? 143% year-over-year revenue surge. I mean, just let that sink in for a second. That's not 14%. That's 143. You've more than doubled your sales from the same time last year. Now, in any normal universe, that is a green light for a massive party. You'd expect the stock to soar, right? Champagne corks flying everywhere? But that's the complete opposite of what happened. The market took one look at that incredible explosive growth and slammed the sell button hard. Now, this is the kind of disconnect that creates what we call a battlefield stock. It is either a profoundly misunderstood opportunity or it's a very skillfully disguised trap. And our job is to find out which one it is.
Whoa, hold on. I have to jump in here because this is exactly what everyone watching is thinking. How on earth can these two facts exist in the same universe? A company basically prints money, they're growing revenue at a clip that most Silicon Valley startups would kill for, and their big reward is an 8.38% smackdown after hours? It just makes zero sense on the surface. It feels, I don't know, it feels dishonest. You know, it's like you're looking at a brand new skyscraper from a distance and you see this beautiful gleaming tower, but then you get a frantic call from an engineer who's inside and he's telling you the rebar is all rusted out and the foundation is built on sand. We have got to get past that shiny headline number and figure out what that engineer knows. What is the market seeing that's buried so deep in the fine print of this report?
And that is precisely what we are here to do. And we're going to do it with discipline. We've laid out this entire investigation into 5 distinct stages. First, we're going to look at those surface-level numbers in what we are calling the ugly earnings report. Then, we're taking a virtual sledgehammer to the biggest crack we could find, this massive $151 million write-down. After we've assessed all that damage, we're going to analyze the company's real underlying structure in a tale of 2 segments. From there, we'll go through management's rebuilding plan and see if their new blueprint can actually hold any weight. And then finally, we will deliver the Iron Financial verdict. All right, let's get to work.
All right, Section 1. So before we get to the earthquake that shook this company, let's just examine the initial tremors. You can think of these as the hairline fractures that started showing up on the surface of the earnings report. That 143% growth number, that was the shiny paint job. But these next few slides, they show the cracks that the professional money managers, the big dogs, saw within the first 5 minutes of reading this thing. This is exactly where the story of doubt begins.
So here it is, the first major fissure in that big bull case. And yeah, sure, $408 million is a huge jump from last year. We've established that. But here's an absolutely critical lesson for every investor. The market doesn't just grade you against your past self. It grades you against the promises you make and the expectations it sets. Wall Street was modeling almost $476 million. So AeroVironment didn't just miss. They missed by a country mile, a staggering 14.21%. In this game, that is not a rounding error. That is a catastrophic failure to deliver on your promise, and it immediately signals one of 2 things to investors. Either management has no idea how to forecast their own business, or something went horribly wrong at the end of the quarter that they didn't see coming. And believe me, neither of those options inspires a whole lot of confidence.
And the bleeding wasn't just on the top line. This slide shows us the second crack, and this one goes straight to the bottom line, to profitability. They also completely failed to deliver there. Reported earnings per share, or EPS, came in at 64 cents. The consensus on Wall Street, 69 cents. So let's be perfectly clear. They brought in way less money than expected, and they were less profitable on that money than expected. When you miss on both revenue and earnings, well, that's the cardinal sin of earnings season. You've just broken the 2 most fundamental promises that you make to the market. You've handed the bears all the ammunition they need to argue that this whole growth story is just a hollow shell.
Okay, stop right there. This chart, this right here, is the giant flashing neon red flag for me. Forget the misses for just a second and look at the raw profitability of the business. Gross margins just completely collapsed. I mean, they didn't just fall. They fell off a cliff, going from a really healthy 40% last year all the way down to 27% this year. That is a catastrophic drop. So let's connect the dots here. They're selling more than double the amount of their product, but they are making drastically less profit on every single thing they sell. So where is all that money going? Is this a supply chain nightmare? Are they being forced to sell a less profitable mix of products? I mean, what is causing the structural integrity of their profits to just crumble like this? This looks like a serious leak in the engine room, and it tells me that revenue growth is coming at a cost that might just be way too high to sustain.
You've absolutely keyed in on the right question. That margin collapse, it isn't the disease itself. It's a symptom of a much larger, much more acute problem. And that brings us to Section 2. We're going deeper now. We're past those surface-level cracks, and we are now investigating the seismic event that truly shook this company's entire foundation. This is what triggered the whole collapse in confidence. This is the core of the damage.
Just look at that number on the screen, $151.3 million. That is the size of the goodwill impairment charge this company was forced to take this quarter. Before I even break down what that means, just let the sheer scale of that number hit you. This is not some small accounting adjustment. This is a $150 million hole that just, poof, vaporized from their financial statements. Now, for a company this size, that is an admission of a massive, incredibly costly, and deeply embarrassing failure.
So it's really crucial that you understand what this accounting jargon actually means in plain English. A goodwill impairment is pretty much the most brutal form of corporate confession you can get. It's the CFO basically coming out and saying, hey, remember that big, flashy company we bought a few years ago? The one we told you would create all this incredible value? Well, we were wrong. We massively overpaid, the asset we bought is not worth what we claimed it was, and we are now officially writing it off as a giant loss. In this case, the charge is directly tied to their space business, and it was triggered by one specific event, the complete and utter implosion of a major government contract called the SCAR program. So this isn't just an accounting entry, it is the financial tombstone of a major strategic blunder.
And this slide right here brilliantly illustrates the communication breakdown that just destroyed so much trust with investors. On March 3rd, just 1 week before this disastrous earnings report, the company puts out a press release to try and get ahead of rumors about this SCAR program. But look at the specific language they chose. Temporarily paused. They also said they were in active negotiations. Now, this language is very carefully chosen. It's meant to suggest a minor hiccup, right? A little speed bump, a temporary delay that management was confident they could fix. It was designed to calm the market, to project an image of control.
And here's the gut punch. This is what feels like a straight-up betrayal to investors. 1 week, just 7 days after telling the entire world the contract was merely paused, they get on the earnings call and admit that the U.S. Space Force decided to terminate our existing contract for convenience. Paused and terminated are not in the same dictionary. They're not even in the same library. One is a speed bump. The other is a concrete wall at 100 miles an hour. And this raises some serious questions about their transparency. Were they just trying to soften a blow they knew was coming? Did management actively mislead investors, even for just a week, to try and manage the fallout? Because that shift in language is the difference between a minor operational issue and a full-blown crisis that directly led to a $151 million write-down. Credibility, once you lose it, is incredibly hard to get back.
Exactly. The SCAR contract termination wasn't just a crack. It was a wrecking ball that hit one entire side of the company. So, now that we've really assessed the damage, it's time to test the strength of the rest of the structure. Is the entire building compromised now? Or is the foundation on the other side strong enough to actually bear the full weight of this collapse? Let's find out.
This slide really breaks down the company perfectly. You have to understand that AeroVironment is basically two different companies operating under one roof. On one side, you've got the Space, Cyber, and Directed Energy segment, the SCDE business. This is where the SCAR disaster happened, and as you can clearly see, it's shrinking year to date. But then you've got the other side of the company, the core business, the main event, Autonomous Systems, or AXS. This is their bread and butter. We're talking about the Switchblade drones, the Puma reconnaissance vehicles, the stuff they are world famous for. And that segment is not shrinking. In fact, it's growing by a very healthy 20.6% year to date. This is the load-bearing part of the company. This is the foundation we need to inspect very closely.
And when you dig even deeper into that strong segment, the picture becomes incredibly clear. The real engine of growth, the powerhouse, is their Precision Strike and Defensive Systems division. This is where you find their famous Switchblade, kamikaze drones, and other loitering munitions. Now look at that number, a 50.6% year-to-date revenue surge. That is immense, explosive growth, and it's being fueled by unprecedented global demand. So this isn't just a solid pillar of the company, this is a steel-reinforced, deeply rooted foundation that is firing on all cylinders. This is the part of the business that is performing flawlessly and is pulling all the weight right now.
Okay, I've got to admit,
Those are some seriously impressive numbers. A record-funded backlog of $1.1 billion is a massive safety cushion. That's guaranteed revenue in the bank for the future. Management is also guiding for a record fourth quarter just based on the sheer volume of orders they're seeing, so the demand is undeniable. And this autonomous systems segment has grown so much it now makes up 68% of the company's entire revenue stream. But this brings us right to the billion-dollar question. Can this one incredibly strong foundation truly support the deadweight of the SCAR collapse and the rest of the shrinking business? Is it strong enough to hold up a structure when another major part of it has just been condemned and basically bulldozed? Because that's the real stress test, isn't it?
And that is the critical question. It brings us to the next stage of our analysis. Look, a building can survive localized damage if the rest of the structure is sound and if there's a credible plan to repair and reinforce it. So, with part of the company in ruins, we need to examine management's blueprint for recovery. What is their actual plan to not only repair the damage, but to rebuild stronger than they were before? Let's scrutinize their strategy.
Okay, so according to the CEO, this is the four-step plan. Step 1, they want to shift away from these really complex, low-margin government development contracts and move towards selling standardized, commercial, off-the-shelf products. This is a huge deal. Step 2, they plan to recompete for that exact same SCAR program, but this time, instead of building to the government specifications, they'll offer their own commercial product. Now, the logic here, which is step 3, is that they're going to absorb all the research and development risk themselves, and yeah, that hurts margins right now, but it allows them to sell the final product at a much higher profit later on, more like a software company than a traditional defense contractor. And then finally, step 4, they are aggressively scaling up their manufacturing with new facilities to meet that booming demand in their core drone business. So on paper, it's a very logical pivot.
Logical? Maybe. But let's get back to reality for a second and look at the immediate, concrete proof of the damage. This slide shows the lowered full-year guidance. They took a knife to both their revenue outlook and their adjusted EPS outlook. So this grand rebuilding plan comes at a significant cost in the here and now. So my question is, how much faith can we actually put in this blueprint? I mean, it's one thing to draw up a brilliant plan on a whiteboard. It is another thing entirely to execute it flawlessly in the real world, especially when you've just demonstrated a massive strategic failure with the SCR contract. There is a huge amount of execution risk here, and this lowered guidance, that's the market's price tag for that risk. They are essentially telling investors, trust us, but also expect us to make a lot less money this year.
And that brings us to the final section. We have inspected the surface cracks in the earnings report. We've analyzed the deep structural damage from that write-down. We have tested the strength of the core foundation, and we've reviewed the blueprints for rebuilding. So now it is time to step back, look at the entire structure, the good, the bad, and the broken, and deliver the final iron financial verdict.
Okay, let's just lay it all out on the table. Our stress test reveals undeniable structural strength in the core of this business. That $1.1 billion backlog is like a solid steel I-beam supporting this whole company, and the global demand for their drone systems is nothing short of explosive. But we absolutely cannot just ignore the cracks. That severe margin compression is a huge problem that just eats away at the value of that growth. And they have demonstrated a pattern of failing to meet market expectations, which completely damages their credibility with Wall Street. And the damage is not superficial, it is deep. That $151 million SCAR write-down was a direct hit to the balance sheet and a clear public admission that they completely misjudged and mismanaged a key acquisition. That is a major strategic failure, period. Which brings us to the rebuilding risk. The new commercial strategy, yeah, it makes perfect sense in a business school textbook, but it is completely unproven in practice for them. They are asking investors to trust them to execute a really complex and costly pivot right after a massive self-inflicted stumble. That is a very, very big ask.
So here it is. Here's the final verdict. AeroVironment is a company with a rock-solid, booming core business that is currently being overshadowed by a disastrous, incredibly expensive failure in a newer, more speculative segment. The bull case is this: that SCAR write-down was a one-time event, a painful but necessary amputation that cuts off a diseased limb and allows the healthy, powerful core of the company to grow unencumbered. The bear case is that the SCAR failure, the margin collapse, and the communication breakdown are not isolated incidents, but symptoms of deeper operational and strategic problems that could spread. So management is now forging a new path, pivoting to a commercial model that could unlock much higher margins down the road. But the ultimate question for you, the investor, is this: is the foundation of their drone business strong enough to build a whole new future on, or are the cracks from this recent earthquake just too deep to repair? That is the multi-billion-dollar question the market is wrestling with right now. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.